I'm happy to invite Prashant Jain to do something different today. So, Prashant will indulge in a bit of a role play. And let's see what he has to do. So, Prashant, the stage is yours. Come, let's give a big hand to Prashant.
Good morning, friends, and thank you for agreeing to listen to me again. So when Prem called me a few weeks back and he said that you must speak again, I said, sure. I thought I have the same old slides, what I've been using for 20 years. So I'll go over them once again. So, but then he said, no, this time you must speak as if you were an RM or an IFA. So I was quite surprised and I said, why me? There are thousands in this country who have more experience than I have. I have hardly any experience as an RM. I said, no one will take me seriously and people will have probably fun at my expense. So he said, Prashant, you are missing the point. I mean, that's exactly the point, that we don't want you to be taken seriously. You have pained people enough with the same 3 slides about the India growth story, about the Sensex compounding, and about low PE investing. So this time people want to have fun at your expense. And he also said that, don't worry, no one takes you seriously. It's only you who think they take you seriously. Because whatever you have said for the last 15 years, most have done just the opposite. So we said technology is very expensive in 1999, and technology funds collected the maximum money. In 2003, we made a slide saying that, SEBI regulations were less tighter then, that why Sensex should be 10,000 before 2010. And that year, mutual funds collected the lowest ever in the history of India, 118 crores, all mutual funds in the country put together. 2007, we said infrastructure stocks are very expensive, quality is very cheap, and all money went into infra funds. 2011, 2013, we again said things are very cheap, buy, and these were the record years for mutual fund redemptions. So, he put it very nicely that, look, people don't take you seriously. So just come and speak. What would you do if you were an RM? So here am I. So I must admit I have no experience of this, but I went back, thought about it. And so forgive me for any mistakes that I make. This is very theoretical, very bookish, and I have never really done what you do. And life is probably tougher for you than it is for me. So I think I would do exactly what I have been doing in this role. I would just focus on educating the customers. And I don't think I would need more than 5 to 7 slides to educate. I would not worry about educated clients. I would not feel insecure that if investing is so simple and if these clients really understand these 3-5 slides, what would be my role? I don't think I would carry that insecurity, because I have seen that educated customers stay much longer in the funds. They complain a lot less and they invest a lot more of their savings into equities, and they get you a lot more referrals. So I would simply go out and educate. And I have seen over time it works. And I will share with you a few slides which to my mind will make it really simple. I would also focus on the right clients. Every successful marketing company, they do something called a target marketing, or they make segments. So when I thought back, I think I would like to focus on the young, those who have very less money. And there are a number of reasons why I would not focus on the rich and old, but rather focus on the young and with very less money. One, because the young are more impressionable. So the mind is fresh. You don't have to unclutter anything, at least as far as investments go. So they would be more willing to listen to me. They would be savers for the next 30 to 40 years. And they would not be consumers, so they would be savers. So they, over time, as their wealth grows, they can become very good clients. Finally, I think young people will are not serviced at all. So someone who is saving, when I started work, I used to save 1,000 rupees a month. Who was interested in servicing a person like me? So they are not bombarded, they are not approached by a lot of people. So I would be able to develop a better bonding, better relationship with them. And they would also refer me to clients of the same age profile. Again, so because young people are likely to have young friends. And finally, one day his father or uncle may be very rich. So one day he will inherit that wealth. Or he may convince his parents also to start investing in equities. So I think this is how I would start. And if I would also assess over time, if this youngster was very demanding, had unreasonable expectations from equities, I would politely decline also. Because it is better to have, in my opinion, lesser number of clients than have unsatisfied clients, because they will go and create a bad name for you. I think when I did some numbers with this approach, I realized the first few years life would have been very tough. Hardly any money in this approach. But the beauty of this business is if you can compound, and I will share with you how this business has not one but three levers of compounding. Over time, it is it can be very, very rewarding. And I will share with you some thoughts there. And I think if I did well for the first 5 years, had few hundred good satisfied clients, thereafter I would not spend too much money seeking out new clients, because I thought that word of mouth would suffice. And to have satisfied clients, I would always keep expectations very low. Let me now, these are the 4 slides, I will not spend time on these, but these are the key 4 slides, which make the case for equities in India very, very strong. I mean, this slide gives you the decadal growth rates of nominal GDP of India. So the blue bars are the real growth, and the bars on top are the inflation. You add the two together, for the last 40 years, the nominal GDP in this country has grown between 14 to 16%. So whichever government, Asian crisis, September 11th, Lehman crisis, Congress, BJP, doesn't matter. When inflation is high, real growth is low. When inflation is low, real growth is high. But the nominal GDP growth, which is the top line growth of all companies put together in this country, moves between 14 to 16%. And that's where Sensex picks up, that it is also delivering the similar kind of returns. And you can see at the bottom, all that has changed in this time, but it does not seem to matter. So this would be my first opening slide. Ki look, this economy grows in different conditions, come what may, and equities are nothing but a slave of the economy itself. This is the second slide. I will not spend more than 5 seconds on this, because I will be thrown out of this room. It tells you a lot. The 1, 5, 10, 15-year rolling returns of the Sensex. If you show the first slide and the second slide, it makes the case very, very clear. And it drives home the point beautifully, the compounding potential of equities. The third slide which I would focus on is, look, if you invest in equities for 5, 10, 20 years, you will earn very well, you will do very well. But if you invest in tough times, when the going is very tough, you will earn a lot more. So on this slide you can see, in the green areas, whenever the P's were below 15 times, if you invested in equities then, the next 3-5 year returns were extremely healthy. And I would use this slide to encourage my customers to invest more when the environment was very challenging, when equities are not doing well, but when the valuations are very cheap. I think asset allocation is more talked about than practiced, and people spend more time in fund selection, security selection, timing, and less in asset allocation. I think I would ask some very simple questions to my clients. What is that portion of your wealth on which you can lose 10-20% money temporarily? What is that portion of your wealth on which you do not need returns for 3-5 years? And help them get the asset allocation right. It is well proven that more than 90% of the returns on any portfolio are delivered by choices of asset allocation and less by timing or by fund selection. So I would help my clients focus a lot on asset allocation. And I think all of us have failed collectively in that job, because the asset allocation of all Indian households towards equities is in very low single digits. So we may say that I am doing asset allocation, but somehow it does not seem to be working. In last 4 or 5 years, we have imported gold to the tune of $200 billion. Sorry, it is $200 billion. And what is the size of mutual funds in this country? In the last 6 years, the net inflows in equity mutual funds are zero. I mean, including the $10 billion collected last year, last 6 years is zero. And 200 billion of gold we are importing in 4 or 5 years. So I think even though it is talked about, people understand things, but somewhere things are not falling in place because the asset allocation in India is miserably low towards equities. In the last 20 years, FII ownership of Indian stock markets has gone from 0 to 24. Promoters are more or less the same. It is the retail which has reduced ownership. So we may say whatever, but fact is that the allocation of equities in household balance sheets is close to an all-time low. That is what the CL report claims. Coming to fund selection, lot of focus, lot of time is spent on this. This is a very simple slide. We have taken the 10 largest funds in the country at the end of 2014. Each one is represented by a color or by an alphabet. And then we have arranged these 10 funds in order of performance for the last 10 calendar years. And what do you observe? I mean, there is no pattern to this. There are no permanent winners, there are no permanent losers over 1 year periods. And so much time, effort, energy is spent on fund selection. So I mean, this is the reality. You can go and do this exercise on your own. So what I would do, I would approach fund selection in a very different way. What John C. Bogle said, that pick up any 3 to 5 funds in the country which have done better than the benchmarks over economic or stock market cycles. Because these are the best funds to invest in. Don't look at 3 months, 6 months, 1 year, 2 year peer group returns. Instead, focus simply on funds which rose more than the benchmark in good times, which fell less than the benchmark in bad times. And they have done it consistently. Because the Sensex itself is compounding for us at 12, 14, 15% a year. Any fund which can compound 3, 5% more than that in a reliable way is our best choice. So I would simply pick up 2, 3 funds like that and stick with those funds and not focus on this peer group. And of course, I would try and not sell a large number of funds like closed-end funds, for example, or sector fund, thematic funds, or even capital guaranteed schemes, because we all know there are deficiencies. These are not the best products to be bought. And finally, I would give a very large part of my clients' money to HDFC, simply because we have been a very responsible player. We have always launched responsible products. Our funds have a great track record over economic cycles. But I think there are a number of fund houses like that, and I would work with a few such fund houses. And this is what the outcome of this approach would have been if I started focusing on young clients and things like that. And I would focus disproportionate time in selling simply SIPs. Because SIPs, I have realized it is easier emotionally to invest through SIPs. The time horizons are longer. So this is a very simple, I have done some modeling. I will share with you the output. So these are the 4 assumptions. So add just 1 client a week. And I have gone back in 1991 because this is when I started work. So I thought I will add 1 client a week. Starting SIP amount will be 1,000 rupees. And every year due to inflation, the average SIP amount would increase by 7.5%. So next year it would be 1,100, then 1,250, then 1,400. I have assumed no dropouts. So the key to this business is have happy clients. That's why I would aim to reject few clients. And you can say if someone drops out, I add 1 more client to that extent. We have 4 funds which have a history of 20 years, and they have delivered a CAGR of 20%. So I am working on a CAGR of 17% because active funds in India have achieved that over last 20 years. It's a very reasonable number. And I have assumed 0.7% per annum trail commissions. I have assumed zero upfronts. And so this is how my number of customers would move. First year 50 clients, 50 weeks, second year 100, 150. I would have 1750 clients today. I would have 1250 clients in 2015, and this is the projection for the next 10 years. The SIP amount average has gone from 1000 rupees to 7000 rupees today. And this is the amount mobilized in that year. This is the amount of earlier mobilizations. This is the total AUM under management. And this is the income at 0.7% of that. In the next slide, I have summarized this and highlighted the 91, 95, 2000, 2005, 10, 15, 20, and 25 rows only. So let me take you to that slide. So this is how I would have earned, how my business would have grown. So we are here in 2015, and this was my age in 1991. I am 48 today, so we are in 2015. I would have 1250 clients. It's not a very large number of clients if you've been in this business for 20 years. I think even just one area of Mumbai, 1/4 of Mumbai can give you that many clients. This is the amount mobilized per year, 6 lakhs, 45 lakhs, 1.5 crores. And last year I would have mobilized 11 crores. This is the AUM. So I would have an AUM today of 332 crores, right? This would be my trail income, 2.3 crores per annum. And now life becomes more interesting. See, you have been increasing your income here it grew 8 times, 4 times, 3 times, 3 times. It keeps on doubling at a very high base. So by the time I am 58, I would be earning almost 10 crores a year. It looks a large number, but I don't think it is unreasonable. The key to this is to think long term, to keep happy, satisfied clients, to add value to them, and believe in the power of compounding. So this business compounds in 3 ways. You are adding number of clients. If I have taken young clients whose income will go on rising every year, chances are my SIP amount will not be 7,000, it will be 20,000 by today, because income levels grow much faster. And the third is appreciation itself. So, and I think, this kind of an income level, and I don't need to engage with my clients if I have educated clients, reasonable clients, more than once in 6 months, once a year, once in 3 months. I think it would give me a fairly good work-life balance. And I would earn, and I would have a lot of happy, satisfied clients whose wealth I would have increased. So when I look at this, I simply feel that Prem should have asked me to do this 20 years back, and maybe I would have made a different career choice. So it's too late to do that now in any case. So this is what I wanted to share with you. I'm done, Prem. Any questions?
Good morning, everyone. I'm Anita Sutrave, and I'm your co-host for the day. We will now look at lessons to be drawn from global wealth management. And for this, may I now invite Murali Balaraman, Partner Advisory Services, Ernst & Young. Murali has more than 23 years of experience in financial services. He's been with HDFC and Citibank in his previous assignments and has a rich experience in consulting, outsourcing, and retail banking. Murali, over to you now.
Good morning, everybody. Many thanks to Cafe Mutual to invite me to this August forum. Today's topic is a little different from the earlier topic that we discussed. The difficulty in trying to deal with this subject is that there are so many trends that are happening in the global wealth management space. To give it justice, I've picked 10 trends that we saw were interesting, but different from the ordinary that we are reading about and seeing in the marketplace, but still have relevance in terms of what a wealth manager can take back towards applying it to his day-to-day skills. So without further ado, I'll just go on on to the first slide. The first thing that we're seeing as far as wealth management is concerned is that for good or bad reasons, the rich are getting richer, and that seems to be a primary fundamental of how the market is really shifting. If you look at the market itself, while the rich is getting richer, there are two fundamental decisions that are impacting them. Just hold on, Sorry, guys. While we look at the fact that the rich are getting richer, in all of this paradigm, and one of the questions fundamental arises is that the top 1% seem to be earning far more, than the bottom 50% of the population. But there's something right that they're doing, and when we analyze the characteristics of these top 1% and the top 10% in particular, we found that there was significant investments in their own current businesses that they're putting forward to. And then, they seem to have a very well diversified portfolio in which their investment risks are really coming about. And that's a trend that seems to be catching on. And if we latch on to that to say that the top 10%, gives us about 40% plus, of the overall income, it goes back to generate value, for the firms as such, in terms of the wealth generation as such. The second trend, that we're noticing is around the fact that wealth is growing across the globe, amongst this top 10%, but Asia Pacific, Latin America, and Africa seem to be growing well in excess of 50%. And when we look at each one of these markets, essentially the growth is, amongst the H&W millionaire population having $30 million plus, amongst the population of $100 million plus, clients, as well as the billionaire population as such. Not that the other markets are not growing, but if you really look at the Europe and the Americas, they're growing at an average rate of about 25, 30 odd percent. But what we're going to see is that these markets will have significant value, in terms of, how the growths are going to take place. I'm sorry, for the slide changes. It'll only be on this slide. So if you really look at it, from a marketplace perspective, you're going to see that North America, is growing largely, in the 25 odd percent. Whereas, if you really go back to the three boxes that we estimated, you're really seeing much higher global growth rates, that is there. And as you get to the higher bands in terms of the billionaires, it's not that they are growing, much, much faster. They're growing at the same rate, as what the millionaires are growing, in terms of market rates. So that's another point that I'd, wanted to bring out as an inference around the H&W growth population. And we're going to see this growth rate continue, across till 2025, as part of the trajectory that we're seeing out in the marketplace. The third emphasis I'd want to put down is the fact that while you see this growth rate in the markets, it's the developed markets, which have still got a significant share, of the H&W population currently. But if you really look at it, there are countries which are fast emerging, in the Asia Pacific region, and they contribute to about 32%, of the overall, mix as such. And if we break that down, into the trends as such, what you will see is that basically China and India will, eventually play a significant role, as far as the Asia Pacific growth market is concerned. So where we're sitting on in India is going to be a fairly significant, place in order to grow our wealth management portfolio. Now, what's the shift is that because our growth rates are going to be better than, what the average marketplace growth rates are, and because of the fact that this region is seeing, a lot more inflow of, money than what some of the other places are, and the optimism, cautious optimism, is fairly positive. It's going to yield us, good results as such. And at some point, the point of inflection, we will actually end up overtaking each one of these individual markets, of Europe and the Americas. So no more fast forwards and backs. See, the fourth trend, that we are starting to see in terms of the market landscape is the fact that we are now moving generations. So while many of us in this room, will probably belong to the Gen X population, which is taking a majority of the decisions that's there, we're moving towards the new millennials, who are now in their early 30s and starting to say, take fairly strong decisions with regards to private wealth management. And in another 10 years' time, they will be at the driver's seats of most of the businesses, whether they are inherited businesses or their own creations, in terms of the decision-making that's there. So the shifts in thinking, are likely to come in as a result of a combination of these three, market inputs that we're starting to see, and the fact that we're going to start a new generation. Now, when I reflect back on Gen X versus Gen Y, I can say possibly, we started off, I belong to the Gen X, so, we started off where computers were possibly introduced with 2 floppy disks. We didn't have a mobile phone when I started my career. When you really look at iPads and iPhones, none of that, existed in any form or manner, during the time we started off our careers. Today, the generation is where, they start off with a tablet, they start going to schools with a tablet, they start to take information off the internet, they no longer visit the branches, as much as we used to visit them, in our younger years. And therefore, the way of conducting business, the way of transacting, the way of absorbing information has significantly changed from, let's say, a newspaper-oriented approach to a more online, real-time oriented approach. And the Gen Y is going to dictate how we really conduct business. And we'll cover that, a little more, as we go into the top 10 trends. So this is the context in which, I would like to start to discuss these trends. The most important thing about the trends is that, there are 3 factors that we saw essentially are influencing the trends. The first, factor is the fact that the consumer behavior or the customer behavior is changing, and how the consumer is making or taking a decision is significantly different from what it used to be taking, and the shifts are quite apparent, when you really look at it, in the subsequent slides. So we'll cover 3 trends, along those lines. The second thing is, because the consumer is changing the way, he behaves, therefore, the response to that is changing, with respect to wealth management institutions as well. And therefore, they are having to think differently. They are having to put in, effort and energy into making sure that they are far more impactful and meaningful, to their end customer base. The third place is the market is not far behind. The market is starting to respond to both of these pieces, and they could be, either in terms of market drivers, which are impacting both of them, or in terms of regulatory impacts, because they are saying that they want stricter norms in order for this to be governed and disciplined about. And we'll talk about 3 or 4 of them, which are, more fundamental in nature. So, without leaving that, I'll start with trend 10. And this is a fairly interesting trend. The fact is, today we know that women, play a significant role in terms of decision making. So about 50+% of women today take financial decisions, with their spouses and with their family, as such, in this day and age. That is likely to increase to about, 67%, as we go in over the next 5 to 6 years. So, which means, as a wealth manager, if I had to go back and make sure that I have aligned the decision or the product or the service with respect to which, I'm trying to make that happen, then I will definitely need to make sure that my better half is sequentially aligned. We did a dipstick also of talking to people and their better halves in terms of taking decisions, and we figured out that honestly many of them came back and said it's not 67%, it's almost 100% where my wife is ending up taking a decision. So when you really look at that, and when we're trying to go back and sell a product or a service back to a male individual, please be aware that there's a woman who's actually ending up taking that decision, and that's the first trend that we are seeing. Now, what's very interesting is that the amount of wealth on which decisions are being taken is also significantly increasing, for us to go back and take note of. So if you look at the US statistics that's there, about 22 trillion worth of asset decisions are likely to be taken by 2020, and which is far higher than the 8 trillion that you're really looking at it. So if I take it on a global basis and I multiply that by 3, then you're having about 70 trillion worth of asset decisions that are likely to be taken by individuals, and 67% of that if you say is about women. You shouldn't ignore your better halves as far as your lives are concerned. The second trend is that women are likely to live 6 to 8 years longer than what the male counterparts are. Therefore, they're likely to inherit wealth, either from their spouses or, from their fathers and families, as part of what's going on. So that's the second contributor, to this kind of shift, economic shift that we're likely to see as part of the marketplace. The third thing is that, as part of the exit points for Gen X and the entry points for Gen Y, what we're starting to see is that we have both parents working. We have single income parents, or single individual parents, who are taking decisions that's there. And therefore, the workforce mix is starting to change quite significantly. We're seeing far more, a balance of individuals, working in the in the workplace from a male-dominated society as such. So that transition is also likely to go back and impact, the distribution of wealth, in people's hands. And people are taking individual decisions, with respect to their wealth management as such. So the second trend, when we look at it, is slightly different, and that's what I called as trend number 9. Is that our millennials, essentially, the guy today who is the eldest of that, is about, say, 32, 33 years old, has just now gone through a 2007 to 2010 financial crisis, right? And during that period, he's seen a certain level of conservatism that is there. And that has set into his mind, in terms of his decision-making capability. And therefore, he's starting to see how he should deploy his money with a great deal of caution. And he's exercising that caution in his decision-making process. And therefore, he wants to take risk, but he wants to take risk with a certain level of cautiousness, and therefore then deploy his money otherwise. And therefore, what we're starting to see is there is far more cash that's available at the disposal of these individuals, these millennials, and they're starting to look at cash, as a mechanism of investment, cash in the form of, any liquid or debt-oriented funds as such. And equity, has also taken a certain step up, and they're re-looking at their debt exposures, in the marketplace as far as their absorption is concerned. And this is likely to continue given the fact that 50% of private wealth is going to be governed and controlled by these millennials in the next 5 to 10 years time, which means that we will be dealing with people who are far more adaptable. This workforce, and these set of group of people who are there, are far more exposed to the global economy than, what we were when we were much younger, as part of the Gen X population. So when I look at that, and put that together with this, we need to think about different ways in which we can give these guys different types of services from what we were traditionally offering, in the market space, and give them something which relates back to their core fundamentals as such. The third trend is very interesting, because if I look at the overall workforce, in the marketplace with respect to advisors, the average age of the advisor, in the world market force is quite high actually, and they're well in excess of 50 years as such, which is a concern, because if you really look at it, there's a significant level of retirees who are going to come into this band, and therefore the replenishment of that needs to come in fairly well. When I connect this back with the earlier trend of saying that millennials are going to rule the roost, now they are a far younger population as such, and therefore you need people and you need people to replace them and to connect with them with respect to their demands and services as such. And that's going to be another part of the challenge that's there. The opportunities for pursuing alternate careers by the millennial group is far wider and far longer than what it is. And that's going to be the other aspect of how we need to look at them and then try and see how that takes place. The sixth trend is quite interesting, because what we are noticing, and we spoke about that a little bit, is that 2/3 of high net worth individuals want to bank digitally. And that's going to continue, and it's going to increase over the years, given the fact that millennials are fairly comfortable with digitization as a basic form of consumption and a form of decision making. And when that really happens, it's basically about how can I get cheaper advice, cheaper information, but at the same time, have the quality of information which has the same level of depth that is really there. And therefore, there are people who are bringing in automated analytics and information-based services at a far lesser cost as such. And that's why, you find automated PMSs, robo-advisors, and so on and so forth, that come into being. Now, the challenge is, how can you be different? And I'm a wealth advisor, and I need to bring in a certain value back to my clients. Now, what's the value that I will add in addition to what is already available, in the market space? How can I reduce the noise that's available and give something which is of significant value and meaning to the end individual, is the question that, is coming about. And it'll become far more complex, as the years pass on, because this will be the maximum mode, of consumption of daily services, right? Now, when digital comes first, regulation follows, and regulation follows because cyber threat, comes very close. What you've seen is that, we've moved from an age where it's from a paper-driven organization to a more digitized kind of an environment, and we've allowed cloud and other virtual services to kind of come into our customers' lives. And when that starts to happen, then the first thing that happens is that people find ways by which they can take that money out from our customers and threaten us in different forms. And we've seen that in some of the examples in the past, in 2014, where some fairly significant organizations have got hacked into. Information fairly confidential in nature have been secured, and they have resulted in significant amount of losses for them, both in terms of brand as well as in terms of money and monetary values as such. Now, the first and the second one, in terms of digitization, will follow, and we foresee that cybersecurity will be probably one of the leading trends, over the next 10 years, which you will probably have to end up taking, as a security measure, and your customer is going to really look at this as being the differentiating factor. The next one, is fairly interesting, is that a lot of people know how to make money, but a lot lesser know how to keep that money. and possibly, it will be one of the sessions, that will follow from where I probably raised that point. A lot of celebrities, for example, have filed for bankruptcy one or multiple times, around the globe. And I'm sure the same is there in India as well, though it's not publicized, as much as what it is around the globe. And the reasons for those failures evoke into two elements. The first is, are you able to manage your money very well? And are you getting the right kind of advice? Or are you not getting the right kind of advice and then you're not managing it well? Or the second is there a life event that is making me change that particular form of decision making? A divorce, a lawsuit, a settlement that is there, your brand image getting tarnished, or whatsoever, is some of the causes that is there. And therefore, as money managers, one of the things that comes to my mind is to say, how do I really put forth advice which could be longevity driven? And my earlier speaker, spoke about the fact that you shouldn't be selling off your funds, after a 6-month interval, but you should be holding on to them for a far longer period of time, is one classic example of the point. And proving that with data starts to give customers the insights that are necessary to create that particular value. The fourth trend is slightly different, and India fits in somewhere in between. We noticed two pieces of information. The first piece of information relates to, where would I like to retire? Where would I like to live my life? Where would I like to invest, as part of my future? And the second is, where would I want to see my children get educated? How would I like to see them grow up? And how will they have, political stability, as such? So the happiest side of the index is basically Australia, which sees 3% of the population, wanting to migrate abroad, to put into studies, as well as 4% of the population, which basically, wants to moving out of the country. So basically 96% of the population, wants to stay within the country and thrive, which means all future investments are likely to be in that country, and they're not likely to look at a second home outside the country, beyond what they're looking at. On the other side of the spectrum, you see Russia and the CIS, where you're seeing a lot of them are looking at political